For an early look now at what we can expect from the local market, we are joined by Chris Weston from IG in Melbourne. Chris, another night of gains in global equities. The United States in focus again because the Dow reaching another record high. Did you see this one coming? A lot of people we spoke to were thinking we'd see a little bit of profit taking.
Well, I mean, I think you're probably going to get a little bit of more retail money into the market, if anything. I mean, yesterday I had a look at some of the broadsheets, some of the tabloids in the US, and yeah, it was pretty much front page news. So I think that generally means you get a bit more retail money into the market. Whether that means you're going to get some institutional taking money off the table is yet to be seen. But I think you know, the thematic's still there with all the different bits and pieces which are moving markets higher. And in fact, what we actually saw last night was another suite of pretty good data coming from the US. And I think that's part of the reason why markets are moving up. It's not just stimulus that we're seeing. It's not just the fact that the Fed's core under Yellen and Bernanke want to continue putting the stimulus to work for the foreseeable future, and that they're not going to take their foot off the gas anytime soon. We're actually seeing real corporate earnings coming through, record corporate, you know, very, very strong corporate earnings, record cash balances coming through, and the data's been improving. And we saw, you know, US 10-year yields up 4 basis points, so a little bit of selling out of there. So it makes sense that a little bit of money went into the stock market, although there wasn't, you know, there was very modest gains in both the Dow and the S&P last night. So I think that the data was good. The ADP numbers, as I say, were certainly very strong. Good revisions to the previous month. The factory orders were down, but they weren't as bad as what we'd expected. So I think there was reasons to push stocks higher, and just because the Dow's broken out doesn't mean you're necessarily going to book profits. Hopefully we're going to continue seeing higher highs in these different markets. But for me, it's the most important one is what's happened on the S&P. It's the index I follow more closely than the Dow, and you know, that's still looking to break out of the all-time high at 1576. We're not a million miles away from there. So you know, I think once we get a break at that level, then we can start popping out the champagne cork, so to speak. I think what's also interesting is just in terms of what we saw in the Dow yesterday when we broke a new high compared to what we saw in 2007. There's still a lot of scepticism about this market in the US. 2007, when it made its high, you know, the all-time high, then everyone was celebrating, everyone was bullish. It was hard to find a bear in the house. And what we're seeing now is it's just the raft of fund managers and money managers still saying that a massive correction is coming on. So there's still a lot of wall of worry money to be coming into this market. So you know, a lot of scepticism still out, despite the fact that the Dow's trading all-time highs there.
Yeah, we spoke to one of the traders over on Wall Street this morning, and he said he's expecting a stack of downgrades in terms of earnings revisions from the big corporates over the next couple of months or so. Do you see that coming on its way? Because that could certainly be the catalyst for a pullback.
Well, I don't follow US stocks as perhaps closely as, you know, I certainly don't look at US stocks from a bottom-up perspective, so I couldn't say if we're expecting downgrades from these names. Perhaps, you know, any stocks in the defence space which are linked to the sequestration could see that. We're seeing good signs now that the Republicans are trying to push and give an extension to the debt ceiling side of things, which obviously kicks in on March 27th, and if we don't see that being agreed on, then we're going to see a shutdown to some of the government's non-core activities, which would certainly have a bigger impact on sentiment than what we saw on March the 1st. So yeah, I don't follow from a bottom-up perspective. I think if you're an investment house, a lot of these stocks have probably run away from price targets, and therefore that's when you do get downgrades. If a stock's price target goes significantly above, the actual stock goes above the price target, that's generally when you get downgrades to neutral or even sell recommendations, and that can have a bit of effect on stocks. So yeah, I couldn't tell you what's going to happen there, but you know, obviously there is merit behind what he's saying.
Okay, let's also talk about the US dollar and all these improvements we've seen on the data front and what they mean for trading in that currency. You see it as more and more of an investment currency as this data comes through. Just explain that to us, Chris.
Well, let's just take a step back. I think the big thing that people have been talking about in the currency markets for so long is currency wars. That's taken a bit of a step back now. And I think the two things that we've got to look for in the currency markets, which can have reverberations in every other asset class, is the rejection of austerity in Europe. We saw Mr. Bassani coming out last night saying that he wants to break away from austerity in Europe. That's going to have ramifications on the bond market. We did see buying last night. The Italian 10-year was down 8 basis points. But you know, effectively, he's basically saying we've got no intention ever of requesting the outright monetary transaction policy, the OMT, because we simply won't do it. There's going to be conditions attached to that. Remember, Italian yields fell very, very heavily once that was announced, and Mr. Draghi said we'll do whatever it takes back in August and July last year. So I think that's interesting. You know, that's going to be the big situation. It's going to put them on a collision course with Germany. It's going to put them on a collision course with the ECB. It's going to have ramifications for other austere nations as well, such as the UK, such as Spain. And I think that's something that will get legs and will continue to be a big talking point in sort of the macroeconomic community. But I think what we've been seeing is, you know, after Lehman Brothers collapses, the US dollar became very much this kind of risk-on, risk-off currency. If good data came out in the market, wherever it was, you know, we saw the so-called risk currencies, the Aussie, the Kiwi, the Canadian dollar, the euro, sterling, even to a degree, you know, the Swedish krona, all those currencies all rallied against the greenback, all rallied against the yen. What we're seeing now with the raft of good data that's coming out in the US is this really strong correlation between a higher US dollar on the back of this data and a lower euro, a lower sterling, a lower Australian dollar, but also a higher stock market. That's a phenomenon we haven't been seeing. That the trade was short US dollar, long equities. That has broken down. If you actually could overlap a chart of the S&P and the dollar index this year, you know, dollar index is up, what, 4% or so, S&P up, what, 10%, and they are running, you know, pretty much in parallel, whereas strong US dollar is equaling a stronger equity market. Now, if we actually see a situation where people around the world, currency traders, real money reserve managers go, you know, the US is actually showing better signs than everyone else because the service ISM numbers are stronger, you know, all the different bits and pieces, the US is creating jobs, you know, as I say, very, very strong ADP job numbers. We're expecting something around 170,000 non-farms on Friday. Yeah, if the US becomes an investment currency, that's going to attract further flows. It's going to change the whole dynamics of the market. Rather than this risk-on, risk-off thematic, you're going to say, let's go into the US because we think the growth prospects of the US, despite the sequestration that's going to hit, is actually better than most of the world. And I think that's a phenomenon we haven't been used to, and it would definitely give the US dollar a little bit more leg up, and therefore the Aussie dollar going below parity over time, euro going, you know, down to 125 or so. So it's an interesting phenomenon. It's something that we've definitely seen it start working this year.
Yeah, so less of a safe haven play going forward, perhaps.
Exactly, yeah.
Okay, I also want to ask you about the Bank of Japan. They'll be meeting today, not expecting too much from this one. It's the last meeting before Kuroda takes over as governor. So I guess lay of the land will stay the same this time around. It's next time that we perhaps could get a bit of a bang for the markets. What do you think, Chris?
Yeah, lo and behold, if they don't do something then, if Mr. Kuroda doesn't come in and excite the market, you know, you are going to see a huge amount of yen buying. You know, it's sold off quite sharply. The dollar yen today is testing that 94 handle. You know, so we're not expecting anything from Mr. Shirakawa. It's going to be one of the most sort of looked past events, I suppose, in terms of a central bank meeting for quite some time. All eyes now on Bank of England and the ECB. We've had the Bank of Canada last night, and that was there wasn't much from that, to be honest. But yeah, the Bank of Japan's a bit of a nothing event. It's really now all eyes on, as you say, on the next one. I think we're actually going to get a pretty big hit. He's going to come in guns blazing, and he's going to show the market who's boss. And I think we're probably going to get an increase the asset purchase program. 25 trillion yen, somewhere around that region, much bigger than what we're used to. They're going to potentially increase the duration of their asset purchases of the JGBs as well, which would be positive. Potentially even look at things more risk assets like REITs and bits and pieces as well. So I think he's going to have to come in. If he doesn't, lo and behold, the yen, we're going to see a huge amount of inflows. But I think what we'll see, the trade going into it, people will be looking to buy dips in dollar yen. Obviously, that's going to have ramifications on the Nikkei, which could have positive ramifications on the ASX as well. So I think people will look to buy dollar yen and the yen crosses going into that meeting on the hope that he is going to be uber aggressive. But if he doesn't, you know, lo and behold, you're going to see some pretty big volatility in the currency markets there.
Yeah, that's going to be a big one to watch. Let's talk about the ECB and the BOE you mentioned out tonight. And these ones could be a little more interesting because everyone seems quite divided on how the market should be positioned going into this.
They are. I mean, yeah, these are going to be two events. I'm looking at the ECB slightly more than the Bank of England. There has been some noises about, you know, cutting rates by certain members. Mr. Tucker talked about negative rates, which would be very negative for sterling. It would drive a lot of money offshore into other assets in Europe and in the US as well. Very negative in that regard. But I think if you look at what people are looking at, so one guy is calling for 75 billion to be added to their asset purchase program. One economist 50, 925, and then the rest out of the 39 looking for no change. I'd sit in the no change in Bank of England. So I think you may see a little bit of buying in sterling on the back of that. Depending on, we don't get any minutes on it. There's no accompanying statement of Bank of England, so there's not so much you can go on this. But the ECB is huge. I mean, you know, we're certainly, if you look at where euro dollar's trading today, sub 130, below the 4th of January pivot, 129.98. The market is gearing up for a change of language from Mr. Draghi. Now, if you recall back in June last year, just before he cut rates in July, they did say downside risk to inflation. That was the code word the market used, that we knew next month there was going to be a rate cut. If he changes from finely balanced to downside risk prevail, the market will smash the euro. It's already been hit pretty hard, but I think they'll hit it pretty hard on the premise that we are going to get a rate cut in the following month. So looking for that code word from Mr. Draghi. There's a really finely balanced argument. Remember, they back in December, they cut their CPI forecast to 1.6, so it's well below the 2% target that they've got already. Mario Draghi's been coming out with some interesting comments. You know, last week he talked about CPI significantly below 2%, at 134 in euro dollar. He talked about, you know, huge downside risks to their inflation and growth forecasts. But at the same time, the ECB's chief economist, Peter Pratt, came out and said that we're seeing green shoots in a nascent recovery. So, you know, it's very conflicting at the moment. 1.6 is still quite low anyway. If you believe that they're going to come and they see downside risk at CPI and they're going to downgrade it, there's a pretty good chance that they're going to come out and change their language, in which case, you know, you're going to see an interest rate cut being signalled tonight, in which case the euro comes in. If they don't, then the euro goes up. So I think it's going to be interesting. There are merits, you know, positives about cutting the rate. 25 basis points is, you know, not a massive deal, to be honest, but, you know, it'd certainly help Italy. It would change the dynamics in terms of the LTRO repayments. You know, remember, a lot of these banks are sitting on huge amounts of capital which they have to pay, and obviously that's the interest rate is linked down to what the central bank refinancing rate is as well. So the lower the rate, the less incentive effectively of paying back the funds early. So there are some bits and pieces, but all eyes on the ECB. If they change their language, euro goes down. If they don't, I expect euro to probably go up a little bit because the market is positioned for that now.
Thanks for spelling it out to us, Chris Weston from IG. See you next time.